Morning, man.
Hey, good morning. How are you doing?
Doing all right today.
You
Still
feel?
a little under the weather.
Yeah. I'm sorry you've been.
Yeah, I had a rough day yesterday, man.
I'm sorry. That's awful.
It was crazy because I woke up at about 6. I couldn't sleep, first of all. 6 o'clock in the morning, I was up. So I came on. I set up my charts, looked at the market yesterday. Then I got on. You weren't even on yet. I was on about 7:10, right?
Yeah.
7:10, 7:15. And I was waiting on you to come on. I was like, I just feel horrible. I just got up and I went and checked my blood pressure. My heart rate was at 40.
Oh wow. Your heart rate
And
was at 40?
at 40. Yeah. And I was like, should I go to the hospital?
Yeah.
You know? So I just laid down, man. I couldn't get out of bed all day long. I couldn't get out of bed, you know?
Yeah.
Probably should have went because I feel horrible.
Yeah.
I felt just horrible, man.
Wow. I'm sorry. Did you eventually call the doctor or get something for that?
No, my wife is taking me in today after the session. I'm going to go in.
Okay. Jeez.
Get to see what's going on. I thought it was just because of my hernia, but it's probably something more. 'Cause that's the problem. When you have one thing wrong, you can't really pinpoint whether it's something else.
Right.
It's just miserable, man. Getting old.
Uh, yeah.
Getting old.
Wow.
Shit. Yeah, I was
Wow.
like, something is not right, man. So it was like 40. I was like 40, and then I was reading. It said 40 is good if you're an athlete.
Yeah.
It's
Exactly.
not good if you're not an athlete.
Right. Right.
How'd you make out?
I didn't have a good day yesterday. I ended up pretty much break even on the whole day. uh,
Okay.
both sessions. I
Both
lost
sessions?
both sessions. I lost and then I won and then I lost and then I won, and I was just like, I ended last night's session very early because the market was just not giving us anything.
Okay.
Yeah.
It looks like it's been kind of like a weird week. If
Yeah.
you look at the pivots, that 3332
Yeah.
is the monthly pivot, the weekly pivot, and now basically it's the DM2, you
Yeah.
know?
Yeah.
So it's kind of been hanging under that around. It's like a really tough nut to crack going up or down. It seems to be just drawn back to it like a magnet.
Yeah. Yep. Yep.
Yeah.
Fortunately, we're below my hedge. Are we below yours now?
Mine is no. I'm at 30, 20. I'm 26. And where's yours?
Mine is at 37 now.
Hold up, you're 37.
Yeah. I moved my, I was able to,
And you
I got out of mine and I was able to move it up, and I moved it up to like
oh, you moved
41.
it up. Right.
Yeah.
Okay, good.
And
Good.
then I moved it up to like 41, and then it was coming back down. I moved it back down to 37, and then I got hedged.
So your head's at 37.
Yeah. Yeah.
That's a better place than I am. All right.
We'll probably get
Where's
down
your
there. We were below your hedge a little bit earlier today, about 3:30 a.m. We were down
yeah,
at 25.
yeah, I can see that, yeah. The problem though, it looks like it still wants to come down,
Yeah.
you know.
Yeah.
It looks like it's coming back down to the DS1. I think we have Jackson Hole today, right?
Yeah, Jackson Hole today. Yeah, I don't know what's going to come out of there today. If anything is going to be released this morning while we're trading. We have core. No, we don't. What do we have?
No, we got
We
Powell
have
speaks at
Powell
10,
speaks at 10. Okay, yeah. So we'll put that on. Yeah.
and then President Trump speaks or Trump speaks at 12, and then we got Jackson Hole.
Trump
So I'm
speaks
wondering
at
if it just
12, huh? Wow.
yeah, but it's the orange folder, so that's kind of weird, you know.
Yeah. Wonder what he's going to talk about. Hmm. Okay.
You realize I still don't have my cable and internet backup yet?
Oh, you don't?
Nope.
You're still on. You're using your phone?
I'm using my phone, yeah.
Wow.
They're supposed to come to my house. They're saying that everything is fixed, but
Yeah.
mine isn't. So they're coming to my house between 8 and 10 today.
Oh. Okay.
It's probably living in New Jersey. It's not like New York. New York, if you call somebody, they're there. The further south you get, more country it gets. Has Brock or E-Man anybody been on?
Rock yesterday and the day before. E-Man haven't seen him. No.
Yeah. So you might as well take the alarm off. Do you wear your Apple Watch to bed?
No, I charge it overnight, but I wear my Aura ring to bed.
Yeah, I wear it. I wear it. Yeah, I do that.
Yeah.
Where we at with your account, equity and everything?
Let's see on this one. Equity is at 33.86. Oh no, sorry, that's the balance. Equity is at 873, and margin level percent is 86.36.
Okay.
So not great, but better position than I was in.
Yeah, you're in better position. Yeah. All right. You know, the problem I'm also having is I'm not really eating because I can't eat with this salsa because
Yeah.
you have to have small, very little food because if you eat, it pushes it out to your esophagus.
Uh-huh.
So that's the other thing. I'm so weak.
Yeah.
I'm just tired, man. I need the weekend to just figure some shit out because I can't keep living like this. This is rough.
Yeah. Wow. Yeah. Yeah.
Hold
You
on a
should.
second. That's Comcast. Hello. 1 second, Mike. I'm back. Sorry about that.
Yep, no worries.
What'd you say? Between 8 and 10. been like tapping this 30.29 for the last few minutes.
Yeah. Okay. So let me just kind of give a little overview of where we are here for everyone. We're looking here at the 1 minute chart. We've been consolidating here for a while, and I've drawn a white box, a white rectangle around the range that we've been in. We had at about 7:16 Eastern time today, we had a failed breakout to the bottom of that range. Created some supports down here at about 33.28, and then popped back up, and now we're in the middle of this range. Above us, we have a pivot right here. You can barely see it because it's under a couple of other lines, but that is the DM2 on a intraday basis. That is where sellers typically take profit. So if you're coming into that from above, that would be where price would definitely stop and evaluate its choices and decide what to do. But we haven't been above that since 3:30 a.m. was the last time we were above that, and we were below that at 3 a.m. So for about a half hour, we had a failed breakout to the top of the range that we're in. Additionally, right above the DM2, we have two other pivots, the monthly pivot point and the weekly midpoint 2, the WM2. So we have 11 pivots every day, ranging from the DR3, the daily resistance 3, all the way down to the daily pivot point right in the middle, and down to the bottom, passing the DM2, we go all the way down to the DS3, which is the daily support 3. We have the same number of corresponding pivots on the weekly chart, or for weekly pivots, and the same 11 for monthly pivots. The daily pivots, we change those change positions every day, the weekly pivots every week, and the monthly pivots every month. These are the only predictive indicators that we have on the chart. The other indicators, which I'm taking off right now so they don't clutter everything up, you can see all of the horizontal lines are pivots except these orange lines, which mark either the Sunday open or the previous Sunday open, which is on the chart here somewhere. It's probably further up here, previous Sunday open. I'll come back to that. It actually might be down here. Anyway, I'm not going to find it right now. We have the previous day value area low, the previous day point of control, and the previous day value area high. Those aren't pivots, but they relate to where a lot of volume has been traded, and typically price will hit those levels as well and act as if they're pivots. Price will stop there, regardless of which direction it's coming from, bounce off of it a little bit or hesitate right there around it, and then either push through it or turn around and go the other way. If you think about the chart like a raceway, and we're trying to trade with momentum and trade with direction, the pivots and these other horizontal lines are like stop signs along the way, where the car stops, and so you never really want to trade right into one of those horizontal lines. So if I add the pivots back here, if I add the indicators back on here, then what you want to pay attention to are these blue dotted lines here on top, blue dotted line here on the bottom, and the blue solid line that runs right through the middle. You can't really see it because it's going over this big blue horizontal zone here, which is the zone that marks last week's low of the week. So you can also look at this chart and see here on the 5-minute that we have dipped below last week's low of the week several times, but each time it's failed and it's come back up. So it's, at least for for today, it's been hard for us to get below that point. The last time we were really below it was we dipped below it for a tiny bit yesterday, and then between Tuesday and Wednesday we were below it for a little bit, but essentially failed breakouts all to the bottom of this big horizontal line right here. So we'll see if we can push down through there today. It looks like price has been showing some bearish tendencies, but hasn't really been able to push through there. If we flip over here to the DXY, the dollar index, this is on the top right here, we have the dollar, the DXY, which is the dollar measured against a basket of 7 other currencies. That has been pretty sideways since yesterday. Came up a little bit in the between the Asia session and the London session, but then has been pretty sideways from London up to where we are now. And this is the same chart down here below, is the DXY on a 1-minute chart. So you can just kind of see that we've been sideways there. The dollar tends to move inversely to gold. So when the dollar's going up, gold is going down, and vice versa most of the time. Over here on the left side of the chart, we have the 10-year U.S. government bond yield, which has also been sideways, and it also tends to move inversely to gold. There are exceptions when both of these are moving in tandem with gold, but we'll discuss those cases as they come up. Over here we have the VIX, the volatility index. It's at 16.56. That is on the high end of the normal range. When it gets up to 1920, you want to start thinking about seeing a lot of volatility in the market. The markets are jittery. Right now, we've got it would be kind of indication of smooth sailing. All right, the other indicators that you want to look at on this chart, as same as the previous chart where I talked about the channel. You also want to look at, I'm going to bring this over here, these support and resistance zones. The red lines and orange lines are the resistance levels, and the green ones are the support levels. So we have an indicator that draws those in here. Most of the other indicators here on this chart you don't have to pay much attention to. The one down here on the bottom is a volume indicator. When it's yellow and moving up, that means that volume is increasing. Doesn't mean price is going up, it just means volume is increasing. Volume could be increasing to the downside. And when it's blue, it means volume is decreasing. You also want to pay attention to anytime you see a little swing high or a swing low, like down here. You want to pay attention to those. If I tighten this up a little bit, you'll see we have a little green rectangle down here that says bull volume, and another red rectangle up here that says bear volume. So you want to pay attention to those. This blue line here that says pancakes, you don't have to pay attention to that at all. It has nothing to do with anything. It's just a reminder for me about a hedge that I have on my spot gold account. All right, so these are all spot gold charts that we've been looking at, except for the dollar and the yield and the VIX. The others that I've shown you here have been spot gold accounts, spot gold charts. This is the only futures chart that I have up. It's a 10-second futures chart. This is the one that I trade futures off of, and I'll be trading off of this morning. You'll see that the price is different from spot gold. Spot gold is at 33.28 and futures is at 33.70. We don't pay a lot of attention to the futures price. The futures chart moves in tandem with the gold, even if it's at a different price. Every tick up on gold spot is a tick up on futures. So we do all of our charting on spot gold, and we do our trading, or at least I do the trading today on futures. Tono might be calling out some spot gold trades on his end. Lastly, I was going to bring up MetaTrader so I can show you a little of the charts there, but let me just finish showing you here. The US dollar over here on the FX Blue chart to the right, we have, we're really paying attention to the US dollar and gold XAU. That's gold, that's XAU gold, that's USD dollar. This strength differential kind of gives us an indication of how strong the uptrend or downtrend is. Excuse me. Had to sneeze. And we can see down here on the bottom that we have retail traders that are about 60%. 60% of them are long, 40% of them are short. That's kind of a counter indicator. All right, I'm going to bring up MT4, but in the meantime, enjoy the music and look at the charts. Okay, this is MetaTrader. I'm running this on a PC to my left, but pulling the image in here to the max so you can see it. Here on the upper right, we have a 15-minute traditional Japanese candlestick chart. So you'll notice all of the other charts were Hakanashi candles. And if you go to the BarcelonaTrader.com, scroll down the front page until you get to the blog posts, and then right above the blog posts is a search bar. You can type in candlesticks, and it will pull up an article explaining the difference between Hakanashi candlesticks and Japanese candlesticks. And also you'll notice, before you search for candlesticks, you'll see that I think the first article of the blog posts has to do with why we chart gold on spot and why we do price discovery on futures. So I think both of those articles are relevant to what we're doing today. So we have 15-minute chart, Japanese candlesticks here on the left. In the middle, we have Japanese candlesticks on the hourly chart. Farther to the right, we have the 4-hour chart. Right below the 15-minute chart, this one here that's moving, we have the daily chart. We can see that today we've been in a bear market, as we were yesterday, followed by the previous day, which was an engulfing bull market. Here in the middle, we have the US dollar against the Japanese yen. In this case, the yen is a stand-in for gold. This is a very good chart for, determining whether you should enter or not. We kind of look at what the yen is doing, as long as we have observed that the yen is moving in tandem with gold, as it usually does. And then the FX trend, which tells us how strong a trend is in one direction or the other. And lastly, we have our Renko chart here, which moves according to price, not according to time. So if that's just standing there, like it is now, it means nothing is happening. There's no volume. Price is not moving at all. And then to the left of that, we have a 1 minute, over here a 5 minute, and then a 15-minute Hakanashi chart on MT4. Now we have the same Hakanashi charts on TradingView that we were looking at, but the reason we also look at them here on MT4 is that we have a really good indicator that draws these support and resistance lines for us that sometimes aren't the same ones that are showing up on MetaTrader 4. Or if they show up on MetaTrader 4, they show up as single lines, not zones that are thicker, which is the way that these show up here. And these zones have proven to just be incredibly accurate. Looks like we're getting a little break to the downside here. So let's flip back to futures. Let me look at that spot here. So it's another breakout to the downside of the range that we were in. If it can break this lower support here, there might be a trade.
Good catch.
Okay, so I'm just observing also that on the 1 hour chart on MetaTrader, we are hitting a big support zone right here, the chart in the middle.
Mm-hmm.
So, and I see it here on the 1 minute Hakanashi. We are also hitting the support zone with another support zone right below it. And then by the time we're through these two support zones, we'll be hitting this big support zone on the 15 minute. So maybe not something to trade until we get down here below this swing low on the 1 minute chart on TradingView. And right below that, we have the what is this? The DS1. So not as straightforward as we would have thought.
What I'm not liking is the support zone on the daily pivot.
Yeah.
Right above the DS1. Well, sitting on the DS1.
Yeah, I see that.
I'm not liking that at all.
This one right here, yeah.
Yeah.
All right, let's settle in and change our camera perspective. All right, looks like this breakout is failing, coming back into the range again. All right, we have 1 minute for the hourly candle, 8 a.m. in New York. All right, that's 8 o'clock. Nothing.
Nope.
We are seeing strength differential between the dollar and gold. Gold is a bit weaker, indicating we should be going down. Slightly, at least anyway, but we seem to be retracing back into the zone there on that 1 minute chart. No, it's just a retest. Now we're coming back down. But we do have these support areas right here, so we haven't been able to get below those. You see it's come right down into it there. was able to figure out how to make sure that my cursor shows up on the screen. So now when I point something out, I
Oh,
can
that's good.
make my cursor big, yeah. See what happened just here? We came down, created a support here and bounced off of it, but on the 10-second chart, we're showing that we created a support there. But if we look here at the MT4, we see that we hit a support that was already
It's already there. Yeah. Yeah. That's that support on the daily pivot I was talking about.
Right.
If you go back to your daily pivot chart,
Yep.
you see how if you minimize it, you'll see it, if you bring it up, make it a little larger. And bring it over. See how it's held back all of those candles
Yeah.
from going down?
Yeah. Yep.
Yeah. We probably won't see much nothing until Jackson Hole. That's
Which
what it
is
looks
at
like.
10, which is 2 hours from now.
Yeah.
But
Yeah.
we have each hourly and half hourly candle until then, and we have the 9:30 equities open. I don't know. It feels like we'll get a little movement before then. So, for those watching, Jackson Hole is an annual central bankers summit held in Jackson Hole, Wyoming, and the chairman of the Federal Reserve, Jerome Powell, is going to be speaking at 10 a.m. And typically, when they speak, any of the Fed members speak. Well, first of all, they have blackout periods where they can't speak, but sometimes in between their meetings, they can speak publicly. And frankly, they try to be as boring as possible and not make any news. Um, in fact, if you tell the chairman of the Federal Reserve that he or she, when it was Janet Yellen, are boring, they take that as a compliment and they say thank you. And that's, I'm not kidding. Um,
Yeah.
and but what everyone tries to do is really parse their language and read between the lines. Is he giving any kind of hint? And in this case, you know, the Federal Reserve has a dual mandate. They really only they have several tools, but the main tool that they have is adjusting interest rates. And what they're trying to do, the two goals that they're trying to meet is stable prices and maximum employment. And right now, we're entering a period of stagflation where we have inflation and growth is stagnant. And and so sometimes lowering the interest rate helps one of those things. It might help employment. If you lower the interest rate, businesses can take out loans, hire more people, make investments. But at the same time, by lowering the interest rate, you're pumping more money into the economy and it increases inflation. And so, what everybody's going to be looking for with Powell's speech today at 10 a.m. is going to be, is he indicating more that stagnant growth is the problem? Or is he indicating more that we still need to fight inflation? We still need to be cautious on inflation. Saying one thing or the other will give an indication of whether he is more likely to lower interest rates in this next cycle in September or keep them the same. If he has a dovish stance on interest rates, meaning it's more likely that he's going to lower interest rates, then that will impact gold. Gold should go up. If he gives the indication that we still need to fight inflation and that we're not ready to lower the interest rates yet, then gold will either stagnate or go down. That's what we're looking for at 10 a.m. And when we get to 10 a.m., we'll put his speech here live, so we're streaming it together and watching as we trade, watching and listening. Wow, John Bolton's home just got searched.
Really?
Yeah,
I wonder what that's about.
you know, he's been a critic of Trump.
Yeah.
Let's see. Just saw that headline come up. FBI searches John Bolton's Maryland home. The FBI confirmed agents were searching the home of Mr. Bolton, President Trump's former national security advisor, who is now a frequent critic of the president. Let's see, I'm going into the article. He was accused during the first Trump administration of leaking sensitive government information, but the case went nowhere. Asked about the visible FBI presence at Bolton's home, a spokesperson... Oh, look, we're going down now.
Yeah. Let it break that DS1,
Yeah,
because right now it's still laying inside that support on the daily pivot.
yeah.
It's also on the support on the 1 minute and the 5 minute and the 15-minute Hakanashi.
Yeah.
So it reversed on us.
We're at a swing low here on the 1 minute chart too.
Yeah.
And we've got the DS1.
Think about getting out of this trade if it starts to go back up.
Yep.
I don't think it's done yet.
Where you're at 27?
Yeah, I'm at 26 and then change, basically 27.
Yeah. So you're like right now.
Yeah.
So are you going to get out of it and just wait and see what it does, just in case?
Yeah, I think I'm a little like $9 negative right now, so I gotta wait for it to come back a little bit more. It was in profit, and I just didn't do it.
Yeah.
Thinking maybe I should have.
Yeah. Sometimes, because if it's on its way up, the $9 loss is worth it just to get out of it.
It's worth it. Yeah. Yeah.
All right, we have 1 minute for the COMEX open. Yeah, that is it. Okay, now it looks like we're coming back down. Right back into the original range that we were in when we started the session. Might take this. Nope.
No.
Morning, guys.
Hey, Rock.
So, Rock.
Morning.
You doing?
What's new and exciting?
Nothing. Just this. You know, so many things. The Renko for one.
You having problems with your ankle again?
No, I don't. No problems. No, it's working beautifully. Ooh, so there's a 10 o'clock news.
Yeah, we have Powell speaking at 10.
Right. Wow. Lots of movement today.
Mm-mm. Depends,
Yep.
I guess, what chart you're looking at. Yeah, I guess so. Yeah, the 1 minute's been moving a bit.
Mhm.
You can't trade it.
No. One minute for that 8:30 candle. the downside here, we're approaching this DS1 pivot right here, right below this swing low, and we still need to get through these support zones here on the 5-minute and the 15-minute and the 1-minute. So despite the fact that we seem to be moving down, you know, relatively nicely, I guess if you're trading spot, you might be able to trade this, but it's just a little too dicey for me to get into a futures trade here. And that's because with spot, we have a little more leeway and can hedge if it goes against us too far, but we have a little more leeway to let it go against us, you know, all the way up to 15 pips against us. But with futures, I have a very tight stop loss set, so I can't afford to chop. Hey, right through the DS1 right there, right through it.
Yep. That's what we're waiting on.
Yeah.
And that's why I didn't take that sell off.
Yep. Yep.
All right, so we got a trade coming in.
It's a little overextended right now. I'd like to see it form a little support here. Or, yeah, find a little support here. And then break through it again. There we go.
I'm in.
Not in yet.
It's negative, so hold tight.
Yep. A little support here on the Renko. I see support line. There we go.
Yeah,
I'm
it's
in.
reversing on me. You would have been out by now. I wouldn't have got in. Okay.
Damn it.
Took you out, right?
Yep.
Yeah, it's too funky.
That was a bad entry. I shouldn't have entered there.
Yeah, I told you I was going to tell you to hold out because mine was still negative. Just trying to go positive now. All right. I took 90 on that.
Morning.
Hey, man.
Who's that? E-Man?
Yeah, what's up? What's up?
What's up, brother?
Made it, man. Made it. I'm trying.
All right.
No- You just took a sale?
Yep. Took 80.
Nice.
This been the worst summer ever.
Yeah.
Yeah, it's not good trading.
Trading like this allowed me to go work on my house.
How's that come along?
Halfway through.
All right. That's good.
I've been the problem, man. I've been in so many doctor visits, man.
You doing okay?
Two. Well, they said I am. I don't know. I had to go do a CAT scan on a Friday. Had to get in that machine and drink this iodine, and they shot dye in my veins.
Yeah.
Check on my stomach. They called back and said, first they told me I had a bacteria, then they told me I don't. And then Tuesday, I'm standing in Lowe's and I just went to itching, then broke out. Never
Oh.
know what to say. Yeah, I had to
Wow.
go get a shot. They shot with steroid shot on Wednesday. And right now I'm still itching like I'm a junkie. But I'm getting better. Yeah. I was broke out, man, all over.
They didn't say what it's from.
No, they don't know.
It might be something in your house.
Yeah, I had went to a restaurant and I ate some fish. And I don't know if it was something cooked in some oil or something, but I'm not known for being allergic to nothing unless I'm developing something.
You might have caught something in your house that you're messing around with.
Yeah, we thought about that too.
Oh, Jesus. Come on, dog. we go over here to the 1 minute chart, we see that price pushed down through this bull volume 3 times, wasn't able to break it, and is now back up above it. We're waiting to see if price turns back around and comes down through it.
No one can eat. He can't eat that.
Joe, he'll swallow it.
Here, hold on. Here. Lolo. Lolo. Come here. Come here.
Loki, drop it.
Use the bottle, Hilda.
Drop it. No.
You guys are fucking useless. Get out of here. All right.
We have to report you for verbal animal abuse.
Right. He's eating a wrapper to my protein bar.
Oh. I'm eating a protein bar too. If by protein bar you mean bread pudding, that's what I'm eating.
Oh, there you go. That's what I do for dessert,
Right.
because protein. It's either frozen grapes or blueberries or protein bars. That's dessert.
Boring.
Yeah.
Right?
Yeah.
Yeah. I think we might be going back up from here.
This is so boring.
Oh, E-Man is on. Nice.
Yeah.
And we'll sell into this.
Ah. Ooh.
There you go.
Yep.
Better take that 100 while you can. There's a West Indian saying, Mike, him belly full and him still hungry.
I wasn't going to let it come back on me, but I was holding out for a little more.
What'd you get?
I took 20.
Why didn't you take the 100?
I thought it was going to give me a little more.
You gotta take that, man. Especially the way this futures move. If you just taking your hundreds and getting out, do that 4 or 5 times, you're good for the day, man.
Yeah.
You're swinging for the fences. You're trying to hit the home runs.
Well,
Which is,
I'm working on, I'm working on my entries. I'm trying to only take entries that are going to give me a little more. These little ones tend to go against me too quick.
right. But think about it. What's your largest trade that you in last week? What was the largest number you've taken in profit on a single trade?
340.
That's good. But I think a better approach for your trading, because you've got these quick stop outs at 120,
Yeah.
to just take $100 per trades. You know what I mean? Get in
Yeah.
and out.
Yeah.
Or at least 120 to cover any loss,
Uh-huh.
because you can't do the 3-to-1 ratio with the way futures is moving. Nine o'clock candle.
going for it again.
Having a hard time breaking at 24, 25.
Oh, I wasn't paying attention this time. I sold into the DS1. What an idiot. Well, it is what it is. Today ain't my day. I'll be right back.
Said 2.2 for the Raphael. Jason.
I held on to that one long enough. Finally put me in profit.
I can't wait till we get out of these summer hours, man.
You say. I was talking to you, but my thing was on mute. Did you ever get that platform that I have, the MGC, the new one?
What do you mean?
Remember you was talking about getting the new one like I got?
Oh, the Top Step X one. No.
Yeah.
How you liking it?
It's good. It's just I think I need to jack my lot size up, maybe one or two, because it's hard to make a dollar.
What's your lot size on?
That's what I was looking for on here. It got number of contracts, one.
Yeah, how many? Yeah, just
One.
make it 2 or 4.
Mm.
All right. Waiting, waiting, waiting.
Waiting.
I don't think I'm going to do anything else until Jackson Hole because I'm down $100 now.
Oh. Okay.
The one trade that I had was positive. I just blew that off. Just testing my theory, and the theory was right. Hey, Rock, what's Gail's last name?
Berman, Berman.
Thanks.
Uh-huh.
I gotta take a call. Sige, game. Sì, so che
Okay. All right.
Sì, ara... Val, d'acord. Em trucaràs més tard, perquè jo estic aquí ara fent el trading. Sí, d'acord. Ens veiem aleshores. Sí, no, truco-me cap allà a les dues. A les dues podré parlar. Sí, però fins aleshores no podré. Vale, vinga. Vale, merci. Merci. Adéu, adéu, adéu.
Damn, that's impressive, Mike.
Oh, shit, I thought I hit mute.
But you don't know what he said.
Well, that's why it's impressive.
He said, "This jive turkey sucker monkey."
Yeah, what you speaking in, man? Spanish?
Catalan. Catalan.
Catalan?
Catalan, yep.
Yeah, man. They just had a shooting down here in my shipyard. Shot a dude in the head, killed him on the ship. They
What?
just, I'm talking to people out there right now. They said they got them all on lockdown. I used to work out there.
This happened just now?
Yeah, going on right now.
What happened?
They had a shooting out here at our local English shipyard. Dude shot him in the head on the boat, on the ship.
Jesus.
He got into it yesterday.
Wow. That's Trump's fault, man.
Everything get blamed on it. Huh?
Hey, Mike, you might want to think about doing a bilingual sessions.
In Spanish?
Both. Because I don't think there's a lot of I haven't seen it, but I'm sure there probably is. But what you just did was impressive. If you did that for the people that speak Catalan or Spanish, they might that might be a market all by itself.
Yeah, maybe. I bet there are a lot of
You know,
lot of YouTubers who do it in Spanish.
you should look into it.
Yeah.
I mean, you are the Barcelona Trader, so you should be speaking.
Should be speaking Catalan, right? Yeah.
That's like somebody saying, "I am the German trader," and speaking in English.
Yeah.
I should have traded on that.
So where's your pending at, Mike?
Oh shit, we're getting close. 37.
Oh,
it's not pending. It's
at 30.
Yo,
it's hedged.
It's triggered.
Yeah,
Okay,
I'm in.
so that's
Yeah.
all right.
You know, you can either speak Catalan or you can do trading. Not many people can do both at the same time, man.
Right.
You're a double threat.
Double threat, yeah.
And if you can do it while dancing, you're a triple threat.
Oh. That's what I need to do.
Rog, would you do a like a dancing show?
No, I would not. No one needs to see me dance. No one.
We need to do trading with the stars.
Yeah, that was your idea. Yeah.
We need to get you and a few of your actor friends and get them all in the Zoom room and do trading with the stars and get some ratings.
Yeah.
Like you do it a reality show.
Yeah.
I'll get Whoopi Goldberg and Tina Fey in for that. alone passed through all kinds of verified resistance on the MetaTrader.
Yeah. Oops. All right. I got out of my hedges.
You're out.
Yeah.
Nice.
Very cool. That's really great.
Well, no, I mean, I just got out of the bottom hedge. I'm still in the top one.
Right. I hear you. That's okay. That's cool.
I'm gonna have to get back in.
Into the hedge.
Yep.
Where is it now? Where'd you put it?
34.
You should put it under the DM2. 31.
Can't do it.
That too far away?
Yep.
It's running up on resistance on the 5 minute and and 1 minute Hakanashi,
Yeah.
or did it break through it? You're gonna probably have to get back in.
Almost.
This is so boring.
That isn't what I was going for, but as long as it was there, this is what I was going for.
Which I think is important to put on the table, which is the balance sheet, right? We were talking about the rate cut, but the balance sheet runoff, my own view is I think the Fed should stop the runoff now, right? And that's a signal that we want to sit here and see how things play out, and then maybe in September a cut or later. But I think the balance sheet, we often forget about it. And again, it's small now because we slowed the rate, but it's still there. And I think it's an important signal that we want to sit and wait. We're entering a period I'm worried about. It feels, it's not the 70s, but it does feel like stagflation light, right? It doesn't feel great. When I talk to my contacts, it is something that just doesn't feel right.
Well, what's the balance of risks right now? Because we've heard a lot of your former colleagues say we're worried about the labor market, but it still seems to be solid. We're worried about inflation, although it's only ticked up a little bit. We think it might in the future.
So I'm more worried about inflation in some ways because the labor market numbers are hard to discern right now. You think we're shrinking the labor force in some ways, right? And so we're keeping unemployment steady-ish.
I had to take my cable guy.
So we're not going to see those big numbers of 150,000, 200,000 jobs. Part of it is because the labor market is shrinking.
Can't get the music to stop.
We are mourning here that this Jackson Hole, a wonderful guy, Charlie Plosser, just died. He was head of the Philadelphia Fed before you. I want you to recapitulate here right now, freshwater optimism about the American economic experiment. It was with Finn Kinlan, Ned Prescott, and Charlie Plosser in Real Business Cycle Theory. Explain how that innovation isn't going to go away, even with the political intrusion of the moment.
No, I mean, Charlie was one of my mentors, and I just have tremendous respect for him. I was a director of the Fed when he was president, so I got to know him well. I knew him as a business school dean when I was a business school dean. He made tremendous contributions to education, to economics, and not just in macroeconomics, economics more broadly. And so he's going to be really missed. And he was an incredibly strong and powerful voice for Fed independence.
Speak about centrist America, centrist Republicans, centrist Democrats that took, that within the criticisms of RBC said, you know what, this is about America and this is about our spirit. Is that at risk right now?
Yeah, so I used to, people would ask, what am I, a hawk or a dove? And I say I'm an eagle because I'm from Philadelphia. But now,
I don't get it.
Oh, God.
Ask people from Kansas City. They'll tell you all about it.
Ooh, sick bird.
But I consider myself right now a radical pragmatist, a radical centrist. We've got to get the center to rise up in the spirit of what Charlie and his colleagues did. And reaffirm the centrality of markets. Reaffirm the centrality of democracy. Those two go hand in hand. Human agency is what it's all about.
So we're about 7 minutes ahead of this speech, and one thing that you talked about a year ago when we were sitting here was something that stuck in my mind for the rest of the year, which is that at this point you are looking at anecdotes with almost more importance than the hard data, that I gave you a more real-time view of things. How much is that even more so now, given some of the questions around, forget the politics of the moment, just the collection of data, the surveys that people aren't responding to, things of that nature?
Oh, yeah, just look at employment, right? You have the establishment survey, the household survey, those two aren't quite adding up. There's a lot of choppiness in that data right now. And so, yeah, you have to take that data seriously. And you have to be careful not to make anecdotes data, right? But you do need to listen to what people are saying, and people right now are sitting on their hands. What I'm hearing from lots of people is, I need to let some of this uncertainty. Now, the only exception to that are data centers, right? It's roaring ahead. The only problem is we don't have enough power to power these data centers. But there are areas of the economy that are growing, but a lot of people are just waiting.
Can I know, your Mike wants to get a question in. The temperature's dropped since we started live.
Oh, it feels warmer
It's
than
gone
usual.
43
I'm not going to play.
Do we expect snow today?
Oh my gosh, it's actually warmer than usual.
Tom is not an outdoorsman.
Yeah.
42
You
degrees.
can see Pat sitting there just in his fur coat.
Yeah,
He's
understatement
fine.
of the
We're
year.
all
Carry
fine.
on.
I want to ask you about the framework review, which is something that Mr. Powell is likely to talk about today. What's the most important change that they are likely to make?
If you read the framework review, it was written in a period where we thought interest rates were going to be zero or low forever, right? And inflation was going to be under 2%. And so there was that color to the previous review. That's all going to be taken out, obviously. And I hope I haven't seen the final, right? But I hope that they then emphasize more a balanced approach and more principles as opposed to tactics. Right? We don't need to get into the details of the tactics. That's what the committee does. They need to reassert the principles of the dual mandate.
Well, going forward, under whatever new framework they have, do you think they can eliminate some of the risk that we saw coming into 2020 when Jay Powell here unveiled the last framework, which less than a year later was being junked because of COVID?
Yeah, I get this question a lot. Like, before I went into every meeting, FOMC meeting, did I review the framework and that guided my decisions? The answer was no, right? You face the situation you have in front of you, and you deal with the cards you're dealt. And so the framework provides a broad sense of where the committee needs to go, but day to day, meeting by meeting, it does not drive.
Wait, this is too important. This is breaking news. Do you read the Fed minutes?
Yeah.
Wow,
I was in there, yeah.
Of course, you actually listen too. I am wondering, though, what the risk-reward here is, and just to sort of crystallize the moment, what the harm would be of cutting by 25 or 50 basis points. And you talked about how you penciled that in, it wouldn't be that big of a deal. Are we just making these big, grand pronouncements about the same thing, that essentially it might make sense to cut on the margins, but not necessarily go wholesale to 1%? I mean, is that essentially what everyone seems to be coalescing around?
I don't see how you would go 1%, right? I mean, that's just simply not in the cards. 25 basis points, what matters is not the number, but the signal it sends, right? Because what the Fed is 25 basis points going to move the 10-year? No, not really. The market's going to move the 10-year. It's more the signal of where the Fed thinks the economy is, right, and where it's going. That's why I like the idea of pausing the balance sheet runoff as a signal. These are signals, not actual, they're not going to be reflected in people's mortgage rates or credit card rates.
Before we let you go, how much are people talking about who's going to come in to replace Fed Chair Jay Powell?
Well, all the time. You guys are talking about all the time.
I'm among the Fed members.
Yeah, that I don't know. I mean, I haven't really, part of my deal when you leave the Fed is you have to sort of stay on the sidelines for a while. I mean, obviously people are concerned about that. It's a very important position for this country. And so, yeah, I'm cheering for the team that's making this selection that they make the right choice.
Patrick Harker, thank you so much for being here. Really appreciate it, and I guess go Eagles. Patrick Harker, former Philadelphia Fed president, we are awaiting that speech from Chair Powell, who is going to be speaking here in Jackson Hole in less than 3 minutes' time. Mike, we have been hearing from a number of people the fear of a 70s type of stagflation light. Not exactly 70s, but that seems to be the emphasis so far in the Fed speak we've heard so far.
Well, it's the data that we're seeing. We're seeing a slowdown in the labor market. We're seeing an increase in inflation, but I think the emphasis at this point would be on the light part of it, because it's nothing like what happened in the 1970s. And this is also very early in the process. We recognize what's going on because of what we went through the last time, so the Fed can react. And in the current framework, and I assume this will stay in the future framework, the Fed will do whatever it needs to do to keep price stability. That's going to be their main focus. And if that's the case, then hopefully they are
Hey, Tono, I'm gonna run,
of
man. I gotta run for this
Totally
South
unfair
Texas
question to
pitching
you, but I'm going to go
Okay.
with it. With the
I
new
give- hey, I
framework,
called you
whatever
yesterday.
it may be,
You
does the
did?
Fed
I
Yeah.
might have missed the call. Yeah.
Yeah, I give you a call later.
All right.
All right, fellas.
See you, man.
See you, man. Have a
All
good one.
right, all right, Mike.
take out the idea that we're going to make policy based on what we think is going to happen. And they're going to say, we're going to look at all the data that comes in. So it could be ex post or it could be just consensus.
Do the dots stay?
Look, the dots are, it's all a communication tool, and how do you communicate? Maybe get on Twitter. I will say that we are waiting for Jerome Powell to come out and give his speech. We're less than a minute away. Unclear exactly how he prepped for it. How do you think he prepped?
He had breakfast at the Pioneer Grill.
You saw him?
I said good morning to the chairman this morning, and I did not see if it was, I didn't see if he went healthy or full English.
Oh, yeah. I can guarantee he
I
didn't go
said good
full
morning to the
English ahead of
chairman.
this, but this is going to be a monumental moment for him. His last speech at Jackson Hole as Fed chair, with the whole world watching. Does he address independence? Does he deal with the inflation side of the Band-Aid more than potentially the labor market side of things? And frankly, the international feel here, really notable, as you mentioned.
To me, that's the major thing for me is the international community.
Wow, look at that.
Yeah. Mike has some headlines.
The
Mike.
headlines are out. The chairman has started speaking, and here is the key phrase. The shifting balance of risks may warrant adjusting policy. That's going to get Wall Street's attention because it's opening the door to a rate cut. Here's the key sentence. With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting
Why did that
our
jump up
policy
like that?
stance.
He
The
started
Fed is
speaking.
also announcing its new framework, which is pretty much as we were just talking
Is he
about.
speaking
with Pat
already,
Harker, dropping the reference to the effective lower bound, eliminating the inflation makeup strategy, committing to contain inflation expectations and concern about labor market shortfalls. But the key here is that there are downside risks to employment, the Fed chairman says. The inflation outlook is that it will rise, but perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising, which you can see also rising. The S&P 500 now up 1.3%. Yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
Were you able to get out of that head?
That tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking at these as one-time price adjustments within each sector. So it's likely that inflation is going to go up, but then they think it stabilizes and might go down again.
Well, right now, let's take a listen to Jay Powell, Chair of the Federal Reserve.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply.
At 10:30.
Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2%, and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The declining growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. we expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside, a challenging situation. When our goals are anything like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic, our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painful recovery of that era. It appeared highly likely a downturn. Our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy